Well, it's been a while, hasn't it, Patrick?
It's been a little bit. We've had what's the word I want to use? A lot of change in the air for
A
both
lot
of us.
of
That's it.
couple wars started, couple wars ended. I don't think we actually done anything since before Trump took office, right?
Ah, holy cow!
Yeah, it's been
Man.
that long.
Um,
Crazy.
yeah, but
Yeah,
I was gonna say the last talk we did with the gentleman who runs that course for children or for young adults even or
yeah,
teenagers.
yeah.
They got a lot of good traction there. A lot of people were taking a look at that. That's what I
Oh,
saw.
good.
Yeah,
Did we get a lot of traffic from it?
yeah. Not too bad. Folks were taking a look at that, which because it's a unique thing, right? I think there's not a whole lot of
It,
like actual offerings out there of people, trying to teach
yeah,
kids.
I think it's important that, I grew up in a world where we were living paycheck to paycheck and couldn't afford anything. And, my mom's a World War II child. She was born in 1943, 44. And that smack dab in the middle of the World War II, right? And when after the war, they were all poor and starving, and they didn't know this how to have a money mindset and how to live and make money work for you and how to save. All they did was just hoard. So
Yeah,
I just got back from my parents' house, as a matter of fact, and they have tchotchkes everywhere. I mean, you see all my stuff here. It's 10 times as bad.
mhm.
And, that mindset means to me, I tailored away from that and I had an idea of this is what I want to do, mostly because my uncle was a banker. And, my cousin, different parts of the family, is a banker. So I grew up watching them and learning how to do it. And there's no right or wrong way to do it, right? You just have to save
Yeah,
money and then invest it wisely. And
yeah. As you were talking, it was reminding me of so my grandparents. They're like depression era.
right.
They grew up, 20s and 30s. By the time the 40s came around, they were young adults, and totally different mindset around money, and like money worked differently for them compared to like now. Principles are the same, however, like how you do it has changed a lot. Like it'd be really hard for somebody to just save money in a savings account or save it in their house for it to be enough for it to like work out. Unless you live a really not miserably, what's the word? Like a
Miserly.
miserly, that's the word. A miserly lifestyle and have a high income. That's not most people, right? But they paid their house off. They bought cars cash and they had a bunch of money saved in the house when they passed, right? And
Right. I
didn't
mean,
have
they
a lot of
lived off of their house too, right? After a
yeah.
while.
Yeah. And
So,
then with my mom and my dad, they're kind of like that boomer generation and just different around money. Um, Not radically different. Like they never had new cars or anything like that. But credit was more of a thing for sure, right? And things just started changing on them. But anyways,
yeah, kind of went into a materialistic get things now instead of put away
yeah,
for later
yeah, and I think that's
generation.
supercharged now, right? Like especially with like social media, like it just exaggerates all of that.
Yeah.
So I'm wondering
Yeah.
what the whip back will be. Like I think there'll be a bounce back from that. Like I think, like for example, I was reading an article. There was an article that came out that made a lot of headlines about how the newer generation of young adults and teenagers don't drink. They're like the least thirsty generation of Americans. They don't drink
Drink water or drink booze?
booze.
Yeah, makes sense. I mean, it just makes you sick, right? It's basically a toxin.
It's basically
Now,
yeah,
more majority of them smoke pot or do the
yeah,
vape and
yeah.
do the gummies and all that, So,
So are they healthy or they just change their habits? I don't know. But either way, it was just interesting how the trends change, and uh, there's just a lot of correlation with how social media rolled out in the 2000s and how things play out now. I think, anyways.
yeah, but I mean, the bottom line is you do have to put money away and use it and let it grow Uh, I don't know. You could probably tell me the rhyme, the actual, but I heard something where if you gave, well, put $1,000 into your kid's account every year and managed it correctly, it would be worth $1 million by the time they turn 18 or 25 or something like that.
Probably, I mean, depending on the rate of return. But it goes back to that whole, it's kind of super simple and almost overused. The rule of 72, which is you divide 72 by whatever rate of return you're getting, and that'll tell you how many years it takes for your money to double. So,
so if I want $1 billion,
yeah, exactly. Right now, savings account. Now, so I learned that when I was like in my early 20s. I was my first career gig or job or self-employed, a swing at financial services. Was in a multi-level company selling mostly life insurance, and it was a great experience. I learned a ton of stuff that I never knew about. And first introduced me to the whole financial literacy, and one of the things I used was that rule of 72, and it's a perfect example of how to learn how to make your money work for you. In that you take the rate of return. So you take your average savings account. At that point, this is early 2000s. Your savings account return was like, I don't know, 2-3%, something like that. And you put that in the 72. Well, 2 goes into 72 a whole bunch of times, right? So it's going to take a lot of years for that money, for that $1 to turn to $2 with interest.
41 years, yep.
Yeah, it's just not. So it's just hard to do it.
But there's, I mean, like the money that I have with you, that's doing amazingly well, and I appreciate what you do, right? And I couldn't even tell you what the rate of return is on that, because what they tell you as a financial advisor is advise your people to just put the money in there and let me take care of it and it'll grow. And maybe that's more ignorant on my side, but I know
that's how we like our clients to be.
Yeah. But over time it makes it'll double itself, and it'll double itself, and you make money off of every dime that I put in there, which I don't argue it. I appreciate it, because in real estate, you hire me to be your professional, your guide to sell your house. When it comes to financial advising, I hire you to do that work. I trust you to be able to do it. If I was in there every week and asking you questions and micromanaging you, you would probably fire me because I was a pain in the ass, right?
Yeah, this would be a good fit, right?
Yeah. I mean, basically the same thing. I mean, you probably do a little more PR, politically correct. But,
you're right.
I just fired a client a couple of weeks ago because he didn't listen to me. He thought his house was worth X, and it's like, no, you got to drop the price. No, I'm not going to drop the price. The comps say this. Well, really, it's like he thinks he's King Midas, but everything he touches turns to a lump of crap. So, we walked away, and that was it. I'm just kind of done with it, because, you can only tell somebody so many times, this is how I've been selling houses for 22 years. So trust me or don't. If you don't, we shouldn't be working together. So.
Yeah, it's kind of similar to that, like in real estate, right? You have people who want to sell it themselves, like sold by owner, right? That's a thing, right? I guess that's fine as long as you know what you're doing, right? I mean, there's what they're doing, and they end up
absolutely. There's absolutely nothing wrong with you selling your house on your own if you know what you're doing and you can talk somebody into buying a house from you,
and you have the time to do it.
Well, that's just it, right? I mean, if you're selling a $20 million house, you probably don't have time to sit there and, talk to 50 different buyers and agents and all that other stuff. And if you're selling $1 million house, which is here, or a $500,000 house, it might make sense for you to do it if you're retired, or you think everybody's an idiot, or, whatever. But there's always a trust thing when there's no third party involved to go through the process that we're taught as agents, or you're taught as an advisor. There's a certain way of doing it, and I let you lead, right? You tell me what to do, I'll push the buttons when you tell me to push the buttons, and I don't want to know what you do. I don't have that passion. And you
Right.
probably or might not want to know what I do to sell houses. I do, because there's 700 different little tasks that we have to do to sell a house or help somebody buy a house. So, there's a reason why there's insurance agents and lawyers and doctors, because they're the experts and you have to rely on them.
Yeah, you remind me of a conversation I had with a family member who I love dearly. And every couple of years or so, we're getting to finances or whatever. She's like, Patrick, why don't you get your real estate license and do that?
Sure. I'll get my insurance license. I'll become a lawyer.
No, you know what? You're right. I'll do that tomorrow. It's like, well, because that's not my ideal. That's not my thing. Like, I know people for that. I know a guy named Vito who does that, right? So that's I'm not
gonna. He goes to California.
And it's like he has a more than a couple of decades of experience. I'll have him do the real estate. I'm not going to do real estate.
Yeah, I mean, it just makes sense.
Yeah,
like I could do all the accounting, but I have an accountant take care of all my stuff. I have a banker to help me with the banking side. I have lawyers, right? And it's not like I'm a big mucky muck. It's just I'm constantly gathering a team of experts so I can ping them and understand what the best advice is. And sometimes I have some, and you could tell the audience right now, I have some serious harebrained ideas, right?
No, that's true. And like most evil geniuses.
Whoa. But it's the adventure for me of learning and understanding what you're doing and asking all these different questions. And, just lately I've been down the whole idea of syndications and passive investing and all that, because, I have a buddy that he does the something 100 and he's on the computer every day from 6 to 7 and he's trying to get a 5% gain every day. And that's like his thing. That's his passion. That's what he wants to do. Right. And he started with 1,000. Now it's worth a couple 10,000 and he's planning on making it worth a couple million. And I don't have that passion. I don't have that desire to sit there for an hour and watch little candles go up and down.
Yeah. Me neither.
So years ago, because I read Rich Dad, Poor Dad, and I've read a lot of investment books, and I go down a lot of.
That was my first investment book. That was my first one, Rich Dad, Poor Dad. The first one.
Yeah. It's a great book. Every kid should read it.
Yeah.
Right.
It was so that same company that I was working for, multi-level, and I was like 21 or 22 years old. In their presentation when you first go, that was like one of the books they used in it. And I was like, so at night on the way home, me and my buddy who went, we stopped at Borders and bought it. I read it like within 2 days. I was like, oh man, this makes so much sense. And it made so much sense because we were self-employed at the time with a pool service. And the whole idea, like, man, you bought a job. I was like, man, that's so true. So true. I bought a job. I can't take days off. I don't get paid if I take days. Like, it was just, it resonated in a way that it would not have made sense probably as much if I was still working somewhere, because I didn't have the experience of it, right? And so this is where I got to get to. Business owner and then investor, right? Getting that passive income, which is a good segue to what I wanted to talk to you about, or what we wanted to talk about.
Yeah. So I actually have a buddy who bought a pool service, and he has people doing the work for him, but he's there every day managing the business. And his hardest thing, he already knows what he wants to do with it. He wants to hire a manager to manage the business for him. But that's the hardest thing to find, is somebody that's willing to work for a certain amount of pay and somebody you can trust to manage your business. And that's super tough. I mean, it's way different than running a McDonald's because there's processes and all this other stuff. But I mean, he's replaced his income, but to what loss? What is he losing with it? Like that money that he used to buy, he bought the thing cash. So took it out of his retirement, and now that cash that he spent on it is not making, it's making money for him. It's cash out money, but it's not building for the future. And that's like what I've been kind of digging around. And I was like, and Scott Hill, one of my lenders, the Navy guy, we've had him on the show before. He turned me on to private money note buying.
Yeah, I think we talked about that with him on here. Basically, hard money lending, essentially. Right?
It's hard money, private money. Yeah, private money is the new and improved version of it. It's the same thing, right? It doesn't matter how you look at it. So if you're an investor, you want to do flips, or you want to buy a house and cash out, and for some reason your income doesn't qualify, you pass the DSCR, and there's not really anything else to do. Private money is a different way to do it because you're not following the Fannie Mae, Freddie Mac guidelines. You don't have to do the 80-20%. You don't have PMI. You don't have all these little checks and balances. There's a little more risk involved, but you're also paying a lot more. So let's say you're taking $1 million out to buy a flipper house. Well, you have to bring in like 70%, 30 to 40%. So the LTV or loan to value would be 60 or 70%. And on top of that, that difference, you have to pay like 3 or 4 points of that thing. So if you're borrowing $300,000, you have to borrow, you have to pay like $12,000, $14,000, $16,000 to have that loan. On top of that, you have a really expensive loan. It's not going to be 7 or 6% or even 2%. It'll be like 12, 13, 14%, depending on your risk.
But it's a win-win, right? Because just like you said, if you're not able to get that money through traditional means,
right?
This is an alternative for sure. Like it's a win for both sides.
It's a win, but it comes out of your profit, right? So if you're going to do it that way, you have to look at it. That chunk of money's gone, no matter what. Whether you lose all the money or not, that chunk of money's gone. It has to go into your ROI and your profit and all that stuff. From the borrower side, from the lender side, it's great because the lender, they manage the loan just like a bank would. Like you're paying your mortgage every month, you would pay the lender every month, and then he distributes that to the different investors. And if, let's say that I had $100,000, I put 100 of the 300,000 that he wanted to borrow into that. Well, I would make 12 or 13% annually on that. So 100,000 times that is about $1,000 a month, a little bit more, right? It's like 1,083 or something like that every month. That's a great return on investment. But the bad thing about that is there's no back end growth of that. So your money, you either take that for cash flow or you reinvest that into your fund and then grow your pile that way. Yeah. And out of everything that I've been looking at for passive investing, I think it's like one of the safest things. Even though, let's say that the market fell out tomorrow and I put $100,000 into 3 different flips or investments, that money that I put into there is attached to the lien of the title of that property, whatever property that is. So if it does go into foreclosure and the lender forecloses on them, my money's tied up. I lose that monthly benefit, but then we take the property back over time and then we turn around and sell it on the market. So that's the risk that I take, right? I lose that cash flow for 3, 6, 9, 12 months. And then once everything's done, then I get my money back, and then I do it again and again and again and again. So let me show you what this one is right here. So I don't know if you can you see this? There. Okay. So this one right here, and I can tell you straight up, it's Persevere Lending. You can call them up all day long, but unless I refer you, he won't answer you because it's word of mouth. You have to be an accredited investor and you have to have X amount of money to be able to hold, right? So private money, it's real estate. And here's the nut of it. So if it's $1,000 down, you have a 5-year hold on it, which to me, that's what I'm looking at as my baseline. You turn, after 5 years, you turn $100,000 into $165,000.
That's pretty good.
But in my mind, that's cash flow. That's something that I want to do so that I get money in my pocket, so I can actually give myself like a salary. Because I'm in real estate, my businesses are like 1 month I might make a huge chunk of money, and then I'll be dry for 2 or 3 months, and then I'll make another huge chunk of money. I would like to have like a vehicle that gives me some cash over time, and what I'm giving up is the growth at the back end. Does that make sense?
Yeah. So, and just so I'm clear, what you're highlighting here, the $100,000 comes out to in 5 years, 165. However, you're taking income every year.
Every month.
You don't have to wait 5 years to get the 165. In 5 years, you get your 100,000 back, right?
Yeah. Right. I could pull out as soon as this deal. So again, the 5 years is a baseline I'm using to measure all the different investments that I'm looking at. Mm-hmm. So I could, as soon as, let's say that I do this and it's an 18-month program loan, because all of these private money deals, they're all designed to be painful enough that you want to refinance as quickly as possible or turn around and sell it as much as quickly as possible, because it's painful to have to pay 13% or 12% every month to these lenders, right? So I would get that either monthly or quarterly. So it'd either be 1,000 every month or 3,000 every quarter, and that would be my cash flow. So that would come back to me in my bank account, and I would be able to use that. I have to pay taxes on it because it's passive income.
Yep.
But it's still something I can grow with, right? So I started digging around and started looking at a bunch of different ones, and I've interviewed this guy already. But I have not interviewed these people yet. You turned me on to Percent. We'll go over that in a minute. And I'm interviewing these two next week. I've talked to these guys, and we'll go into those in a couple minutes. These are my yeses, and then these are my absolute nos, and I'll tell you why in a minute. And then these are my I don't know yet. I'm still kind of chewing on it, kind of figuring out why.
And just so we have it all in context here, these are all essentially like private equity, private money types of investments, right? These are not, they're not. We're not talking about anything in the stock market. We're not talking about anything that's anything like that. These are all independent firms or partnerships that are doing private money, or what was the other word we used? You said earlier?
Hard money.
Yeah, you said there was another one. You said that they've used a new word because hard money sounds so harsh.
Yeah, it's private money.
Oh, is it private? Oh, okay, there we go.
Yeah,
private, which is another word for private equity.
Yeah,
that's all these are. These just different types of. It's just what's the difference here is how the offer is structured.
Correct. So what you see highlighted on K, that is a private money, typical lender type scheme, if you want to call it. That's how that works. The other ones like Penn Capital and FISN and Solaris and Blake Capital and Blue Onks, they're real estate funds. They're private real estate funds. What they're doing is they're going out to accredited investors and they're raising capital, sometimes 10, sometimes $100 million, to buy commercial property or do something different with it. Like FISN, what FISN does is they buy swaths of land in Texas near up and coming urban sprawl areas. So if they know that like Fort Worth is going west and they want to buy up 10, 40, 50, 60 acres. What they do is they entitle the land. And these guys do commercial work, so they can either do multifamily, big apartments, or they'll do like strip malls, or they'll do golf courses, or they'll do whatever it makes sense for them to do. And I think they're raising like $100 million, and they're in like their sixth fund. They've been around for 15 years. Okay. And out of all of them, this is the one I'm most comfortable with.
Yeah.
And like Penn Capital, what they do is they buy apartments.
I've heard of them before, actually. Yeah.
Yeah. So they raise money, and then they'll go out and buy a $20 or $30 million apartment. They'll rehab it and make it better. They'll redo it. So, they have all this stuff that they do. And then Solaris does the same thing. They buy multifamily. And then Blake Capital, I think, they do this. Now, Blue Onks does the same thing, but they do it for single family homes. So they do it in Missouri. So they'll buy 20, 30, 40 acres, and then they'll parcel it up, bring in the roads, bring in the sewer, the water, the utilities, and then they sell it off to developers, to U.S. Homes, to Lennar, to whatever, whoever they have relationships with. And they're raising hundreds of millions of dollars doing that every couple, 3 months. And then when they go to sell it, they sell it the whole project to one developer, one U.S. Homes or Lennar or Lion Homes, whoever. But Lennar would only buy like 12 parcels at a time to offset their balance sheet, right? So the value add to the builder is that they don't have to wait a year or two to get that land entitled, and they can buy it on consignment, kind of. It's not really consignment, but it is kind of like consignment. So instead of buying all 60 units at one time, they can buy 5 chunks of 12 houses and build on it, get those sold, get the money back to Blue Onks, and then buy the next set of 12 and next set of 12 and next set of 12. And then by that time, Blue Onks is looking at 4 or 5 other properties that they're entitling. And they're kind of like a machine now. So there's a bunch of different amazing things that are happening that I've just spent like the last 3 weeks just digging down and learning more about. And then there's Gemios, and there's another one over here that I'm looking at. But Gemios is a Forex trader. So it's basically the same thing. Instead of buying real estate, you're diversifying and you're throwing your money into it. And they promise they're pitching the idea of you're making like 35% every year, which the back of my neck is like, the hairs are standing up because, really? So they turned me on to their little Trustpilot wing, and I'm sure that's very curated. So I got to go deep and learn more about that as to how trustworthy they are. But as you're looking here, if you can look at the screen, I can walk you through the basics, right? So we'll look at the private money real quick, and I'll explode that out. So if you put in 100 grand, it's 13%. You get 13,000 a year. You make 1,083 per month, or 3,000 per quarter. And if you multiplied it out by 5 years, you would make $165,000 or $65,000 on that $100,000 investment. So your ROI is 13%.
Is that like what the contract is? That's the engagement. Is it a 5-year thing, or like?
No, with the private money, it's until they refi or sell that property. So it could be 6 months, it could be 12 months, it could be 18 months, and then you get the money back, you get the principal back, and then you reinvest it however you want. You could put another $100,000 into another private money firm, or you can go to Fizzin or Penn Capital, or wherever you want to take that money and sink it in. All right. So Fizzin, again, what they do is commercial real estate. They buy swaths of land, plots of land, and they entitle it for commercial, whether it's multifamily, strip malls, what have you, right? Well, they're working on their second fund. And they have a 1% management fee, meaning they take 1%. If it's 100,000, they take $1,000, but they invest $100,000 for you. And every year they charge you that 1% of the value of however much it is. Just like you charge, right? I mean, you charge, I don't know. I've never paid attention. So to me, it doesn't matter. That range, it's negligible. So you're making $12,000, but they also offer a back end to it, right? And so they offer an 18% back end kick when they sell that property. And that fund, believe it or not, they're working on multiple deals at the same time because they have 20, 30, $100 million. So they're working on multiple deals. As they close out, they give you a profit share of 18% on top of the 12%. Which is huge.
Yeah.
Right. So over 5 years, you're turning $100,000 into 250.
I mean,
or you're taking that. Go ahead.
Not too shabby.
Or you're taking $1,000 out cash per month, and then at the back end, after 5 years, you've taken out what is that, like $60,000. You get an award of $90,000, which all in, that's $250,000. So that's not your reward. You're really making $150,000 off of that capital, off of that investment, because that includes the $100,000 right here. This number is not promised nor guaranteed, so it could be 10%, it could be 5%, it could be 40%, it could be 30%. Right. So just based on what they've done, and past performance how does that work? Past performance doesn't guarantee future.
Not indicative of future performance of someone.
Yeah. There's no guarantee, right? But they've been around for like 10, 15 years. They're based out of Texas. They're good old boys. They're pretty, in my, out of everybody I talk to, they're like, yeah, I don't care if you do it or not. Right. You can if you want. It's cool if you do, whatever. We're just doing this, and we have this deal for September, and there's no hard sale. There's just information. Yeah. So this one, which is Penn Capital, and they do apartments and rehab. They do basically the same thing, but they give you 10%, and then if they're the 18%, which is nominal, you're making about 240. And they've been around for 10 years.
And the minimums are about 100,000, which you've been seeing.
Yeah. So what I have to do is put a minimum on there. Some of them are $25,000.
That's pretty low, actually.
It's not bad, right? So you can take $25,000. You're going to get the same award as long as you hold on to it for 5 years or what have you. So there's another company. You ever get into the mindset of like, this guy's pressuring me? I feel like he's like really, in real estate, we call it commission breath.
Yeah.
Like, this guy is desperate for, this is it right here. Solaris. Great people. They're out of Florida. They do multifamily rehab, right? It's a direct equity fund. Their whole thing is they have a third party back end that takes care of the money for you, so you can really trust it. But like almost everybody I've asked has a third party vendor. And then they start payouts 30 to 60 days. They pay quarterly, and they pay 15%. However, there's no back end offered. So after 5 years, your 100,000 gives you 75,000, which is $1,250 a month. So you're not making a back end, but you have a bigger cash flow every month or every quarter, if that makes sense.
Yeah.
And then again, so break this down, right? I mean, the reality is that there is inherent risk. These guys can be snake oil salesmen. They can be complete shysters. you have to do your due diligence. I'm trying to find actual investors to say, is this a real deal or is this guy like selling snake oil?
And you want folks who've been around a while, right? They can show, they have a track record of success. Like somebody's been doing it for 15 years. That means, I would want to see somebody. I'd want to work with somebody who went through 2008. They were around before that and they're around after that. You know what I mean?
Yeah. That would be like the primo thing. And they've done like 20 funds and they've exited 19 of them. And this is their track record, right?
Right.
Like, I can tell you that like on this website, not Solaris, on Fizzin, I'm looking in their OM, their offering memorandum. There's a whole bunch of other new words that I'm learning, like PPM and all this stuff within their service, their pitch deck. They're like, yeah, 2024 sucked. We didn't make as much money as we thought we were going to make, right? And they're at least they're upfront about that.
Yeah, this is an interesting space in that. So, like in my career, for the vast majority of it, I worked under a large broker dealer, like a Charles Schwab type, or Charles Schwab wasn't one of them, but I worked under a large broker dealer by the name of Securian, another one by the name of LPL, which is much more familiar to folks. And so you weren't allowed as an advisor to do anything with private equity. You just couldn't do it. It wasn't allowed. You had to stick to because of the inherent risk. Because the broker dealer wasn't gonna do all the due diligence to figure out and take on that risk that this is a good investment that we could recommend. They weren't going to do that, and I couldn't do it on my own because it wouldn't get added to the offering. So what would be the point? And then what would be the point of doing it to recommend it to a client? I'd just be taking on regulatory risk there. Like there was no incentive to do that. If that makes sense. So
there's no incentive for you to take that on, not get paid, and then also take on a risk. Saying, you told me to buy this.
Right. So it was just like a big no-no, right? So you just never really messed with it. And talking about speaking of social media and the access to information since like 2011 to 12, just like everything else, just like health, lifestyle, like you name it, right? Everything's like just more information. Like, for example, in high school, if I wanted to work out, I basically followed the guy in the gym. And then after a while, I could probably buy a magazine, but there was no podcast or like a search engine where I could read, get really smart pretty quickly and learn all the ways I could get my gains in. Same thing with money and investing, and it's particularly this private equity space. Like if you start talking about this stuff, you'll start getting Instagram ads and links, everything else, right? They start popping up. And so
every ad I get on Facebook, like I spend 10 minutes checking my messages on Facebook, and there's like 50 of these guys, right? And so I'm just at the point. And I'm going down rabbit holes and TikTok and YouTube, and to me, it's education. I'm just trying to figure out what they're pitching and what to look out for.
And what's nice now, like this space has changed a lot, so much so that they just recently, the legislation got passed or signed that they're allowing private equity. I'm not sure how they're going to do this, or they're allowing private equity to be part of the options, like inside employer retirement. Excuse me. So I'm not sure how that's going to work. It's all pretty new. Maybe it might even be a while because the industry has to figure out how to do that. A lot of this is a response to like, it's just this is where all the returns are at.
Yep. And right? I have seen a couple websites where they're saying you can work with it's commissionable. You can work with your advisor, with your IRA, self-directed, whatever, all these other numbers, 401k, 1031 exchange, if you're selling property, if you have inherited money.
Yeah, because largely this was all private equity, and things like these kind of options were largely relegated to people of a much higher net worth. And so that's who had the access, that's who knew about it, and that's who it's still kind of like that. However, with minimums coming down to 25,000 and stuff like that, they're targeting a much bigger market and trying to get into that 401k business for sure is a lot more money too. Where was I going with that? But as a registered investment advisor, which is where I'm at now, what creates much more independence. You can now offer these things with due diligence, though, and that's the challenge, is the due diligence part. I've been very slow to really want to get behind something because for all the obvious reasons, and that even if it's a legit, awesome organization, which I bet many of these are with great track records, there's still the concentration risk, and that's usually the challenge for most people. It's like, if you only have $100,000 to put it in one, it's like, oh man, that's just like something I could never recommend. I could never tell that to a client to do that. They want to do that. You're going, okay, great. You got to sign a disclaimer here saying that you did it against my advice, right?
Right.
But when you have $500,000 and you do 25,000, it's okay. That's a little different, right? And so, anyways, that's usually the bigger concern now, even for great companies, because great companies have problems. Great companies come across situations, and so that's what still makes it a little bit prohibitive for a lot of families, unless you got you're doing very well, you have a lot saved up, and you have the ability to diversify in this way for sure.
And it's not for the faint of heart, because you could lose your ass.
Yeah, for sure. I've even seen some registered investment advisors groups, larger ones, that are doing very well. They started their own funds like this. It's like a side business, if you will. And so think about that. They have this client base of high net worth clients who have money, and then they know what they have, right? So it's easy to know what they should allocate to this other opportunity where they're doing the rehabs on commercial properties and apartment buildings and all that. So it can work out very well, for sure. Yeah. And if you think about it, there is some diversification in there. If there's multiple apartment buildings going on, there's some diversification there already. It's just usually where I see it, a challenge is the minimums and how that impacts people and how much they have available, because you just don't want to put it all, or it's just challenging to recommend to somebody to put it all in one spot. That's all. Yeah.
Absolutely. Right. And it's like, for the pot of money that I have, the vast fortune that I have, which is not a lot, I'm going to be putting more into your fund, but I see the value in this, and I'm willing to do like one or two of them and check it out, and then ease myself into it and try another one. But a lot of these are minimum of $100,000. Like this one right here is $250 minimum, and they only pay 8%. So I'm like, I'm not going to risk that's why these are all reds. They're like no for various reasons. Like this one right here, Viking, they have a really fancy pitch deck, OM. It's really like, they did it up. But then when you dig down to it, here it says, over the 5 years, your return on investment is 3%, 3%, 4%, 7%, 7%. And then, you get an 80% profit share at the end if they make money. Well, that's too risky for me.
Right.
I'm just not interested in doing anything like that. And
like when you got $10 million, we got $10 million to float out there, then the 250 is no problem, right? Yeah, we could do it.
Yeah. But I don't have that. I wish I had that.
Not yet.
I don't have a rich uncle that left me that, because I have a lot of cousins. So I don't have a rich uncle anyway. It doesn't matter. So things that I saw that didn't work with me, like this one, Novacrest. Nixon was really cool. He was, I think they're in Florida, very chill guy. He was kind of like the same thing as that one in Texas. And then it was a great meeting, and there's no fees. They have you can move your 401k money over if you have it. You get paid every 90 days. And they're offering 25%. I'm like, ooh, but no back end. I'm like, oh, 25%. That's awesome. That's 200. Yeah, that sounds really good. But I did my due diligence on that one, and their office of record is some podunk little strip mall, the back of this strip mall, and it's a behavioral science, not behavioral science, but a behavioral therapy office. So, when you look at it on Google Maps, you're like, that doesn't, I don't know. And then they're really new, like they're not even a year old.
Oh,
so
that'd be tough for me. Yeah.
that's a huge amount of risk, especially for $100,000.
Oh, they're doing 25%, I guess.
I mean, that's probably the lure. And I'm like, oh yeah, that sounds great. And then I did my due diligence, and right away when I saw that that's where their office was, that just turned me off. Right?
Yeah.
This one right here, Nick Lansing, he's the third generation. His grandfather and father's done it. They're based out of San Diego. Hugely trustful. He has decades of track record. No fees, no junk fees. He pays 21%. However, as a 3-year hold, there's no cash flow. It's not guaranteed, but if you have $100,000 and you want to see it grow 21% over 3 years, that's a great investment, right? But you don't get cash flow. You don't get a monthly or quarterly stipend. You don't get any of that.
That's great for like a retirement account or something that you're not touching or whatever. Yeah.
Right. Like if I had $300,000 for each of my kids, and they were brand spanking, 5 years old, I would stick that money in there in a heartbeat and watch that grow over 20 years, and they'd be happy.
And that's it's land entitlements. Is that what they do?
Yeah. So he does the same. He buys lots of land, parcels of land, and chops them up into residential.
Got it. Yeah.
And it's the formula that works. That, I tell you, if you and I were to do it, I think you and I were texting about this. Like, this is something we should do.
I was like, man, if Vito had the time and energy,
right? Or he could concentrate his laser right here instead of everywhere, right?
That's right. We get a saddle on that horse, tame him.
But I mean, I know lawyers, I know bookkeepers, I know private financial investors, I know bankers, I know everything. I have a team put together to do something like this. I have civil engineers that could do all that work. I have a guy that knows how to work within the government and push these types of projects along. Nice. I don't have the desire to.
Yeah, I mean, a ton of work to bring it together, right? And to do the due diligence and then start over again with the next, like the next project and then the next project. Yeah.
But like some of these companies are so funded, they don't even take on debt. They don't need to borrow from it. There's one or two companies. There's like a Christian fund that does it. They don't pay a lot, but they borrow money, so they leverage what they get, and then they can buy a lot more with it. But these guys, they have no debt service, and what they're reporting is real money, real time money, right?
Right on. And going back to like the minimums, that's really the only thing that piqued my interest about the one I had sent you. Not that I endorse it or anything. I just thought it was different. And they're not the only ones. That was a percent. They're not the only ones. I've seen all these kind of proliferate since they started to relax the requirements to be able to get into private equity deals, where it used to be you had to make so much money and you had to have so much saved. Had to have so much assets. But I forget, a couple of years ago, we did a talk about it too when they relaxed that. So, hey, you can be an expert in something. Like, as long as you have a real estate license or you have certain investment licenses, like you don't have to make the money. You don't have to have the assets. So they started to loosen that up a little, and then they're trying to make it available in, make private equity available, like I said, in retirement accounts and employer plans, because it's a measure of diversification, and that's where higher returns at. And so another way they looked at it was discriminating against a whole group of investors, these your middle class investors who why should they not get access to this too? They're trying to figure out how to do that, right? But at $100,000 minimums, that's just not gonna. They're not gonna be able to do it, right? So that's kind of how you're seeing the market start to change a little bit, and these offerings start to change up.
This is great if you want to dip your toe into it, right? And the beautiful thing is, it's like their minimums are 2,500, 500, 5,000, right? And there's no reason for me to take $25,000 and throw it into something that I do my due diligence on, right? And say, I don't know what this mixed advances are, but they're basically borrowing money for cash flow. So
so there's risk. And as good as these numbers sound, what they're not, it takes some reading into to figure out what the actual risk is. And even then, I don't know if you're really able to get to the actual risk you're taking on based on what they provide here. But like you said, it's a way to dip your toe into things without having to commit 100,000, right?
Yeah.
And I still don't think this is for most people who don't have a whole lot saved. Like, this is not the way to do it. You should probably have you save before you start trying to swing for the fences here.
If you're living paycheck to paycheck, this is absolutely not something you should do.
Right.
If it's something you want to get into, my advice is to stop spending frivolously. Stop drinking booze. Stop getting tattoos. I have no problem with tattoos. It's just I see people with like sleeves of tattoos, and I'm like, that's a down payment for a house, right? But I think beautiful art, right? So I don't have a problem with it, like I look at my son, and he's living paycheck to paycheck, and that's what I did when I was a kid too. And
sure.
But there's got to be a time when you adult up, put on your big boy pants, and start paying off all your debt. Stop living off of debt, credit debt, and putting money away so that you build a fund, build finances that work for you.
Like this, what I say whenever somebody asks me if I have a tattoo, you know what I tell them? I tell them, you don't put a bumper sticker on a Ferrari. Come on, man.
Something about where the sun don't shine.
Anyway, that's kind of what I thought was interesting about this. Like, okay, because typically, in my experience in this industry, like, you never saw minimums. You'd see 50,000, maybe 100,000 is kind of typical, and even 250 even more common for these very, very credible private equity offerings. So I'd say take that with a grain of salt, though. They're low minimums with high rate of return. So when you hear that, there's some risk. But some of these you found, like, they have long track record. They've been around a while, and they're worth definitely exploring.
Yep. Like this guy right here, this is my favorite one. They've been around since 2014, but he's been around since before that, raising his own funds with his friends and family, word of mouth. And since 2014, he's been coming out and getting business, just like he's finding me through advertising, through hustling and what have you. And, they had good years. Everybody had a great year in 2022. Right? I mean, 2021 and 2020, 24, he bit the dirt because the whole real estate market tanked. Well, that's going to come back, right? Even if we have like an economic meltdown tomorrow, it's still going to come back. So investing now, it's like companies like this, they're going to be around. They're going to continue to buy land. And that's what I know. So, and that's the perfect thing between you and me, is like, you invest money. I understand real estate. Everything that's tied to land is a no-brainer. Where I get kind of the heebie-jeebies is Forex or stock market or ETFs and crypto, and all that stuff is way over my head. And it's not that I don't understand it. It's just I don't want to understand it.
Yeah, for sure. And because it's not your cup of tea, just like I feel that way somewhat about real estate. It's not that, it's just, I know it's not my expertise. I got the basics. I know enough to be dangerous, but I ain't selling your home. What was I going to say? The other thing I was going to say, what has been available for some time, and this has changed too over the last 20 years, is what is what people have invested in typically to get into real estate. If they weren't doing private money lending, they were doing what's called real estate investment trusts, or REITs for short. Um, and those used to have higher minimums too to get into those funds, and they were diversified funds with large companies who invested in real estate all over the country, or by sector or by state. It's kind of like what you've already found, but they were open to the public. They were public shares that you could find. You could get the ticker symbol and you could see what the share price was every day. They're essentially doing similar things in that they were investing in real estate. And again, it usually be divided up between, you name it. You can get one in government properties, people who lease, buildings to the government. You can get it in industrials, you can get it in commercial buildings, you get it in single family homes. Those always have been available too. However, a lot of those minimums went away, and you could just purchase the share and be into it. However, since you're not putting that big up front to get in, the returns aren't what you could get in something like this. And now in a private money offering where you can get the 12 to 25%, like you're not going to get that in a REIT typically.
You're going to get 5 to 9%, maybe on the outside 11.
Yeah.
And the minimums are a lot lower. So you could probably go like maybe 5,000 or 10,000 or 20,000, whatever.
I mean, depends on the REIT. Just put in $50 a month, So on the flip side, which is probably better for some folks, right? And a lot of
it's like a forced savings, right?
Yeah, and a lot of it's tailored towards, or many of them are tailored towards people who just need that income monthly. So like people are retired or somewhat of a fixed income, and they're relying on investment income to fund their lifestyle, and a savings account ain't going to quite get them there. A money market isn't going to do it either. So you have REITs of certain styles that'll kind of help them get there, if that makes sense.
Yeah, and there's nothing wrong with having a mix of the percent investors, investing with your financial advisor, doing some Forex, doing some passive syndications and REITs. Mix it all up until you figure out what resonates with what you're comfortable with.
Right.
Because everything has.
There's a risk inherent in all of it. It reminds me of everybody thought they were a great judger of real estate from 2003 to about 2008, right?
Yeah. All of a sudden, everybody was a real estate expert.
Everybody was amazing. Everybody was the next, especially in Southern California, or California period, probably. And then 2008 happened, and people who knew the industry, knew how to weather things, and had the hindsight of experience, were the ones still in the industry afterwards. And it's very similar to investing in the stock market as well. Like 2000, same time period, the stock market doing the same thing.
Yep.
Like everybody thinks they're Warren Buffett when the market only goes up. You know what I mean? And so,
I prefer to use the term Nancy Pelosi.
Nancy Pelosi, yeah. And so, it's just when everything's going up, you think you can't go wrong, and these things can go wrong. And so you just got to understand your risk appetite. Make sure that you're diversified and you have the money to can I take this loss? Yeah, I can take this loss. Okay, let's do it. Right.
Yep. I'm selling a house. I'm going to have a lot of equity. I'm actually selling a duplex too. So I'm going to have a lot of taxable, not that I want to use it, but at least I'll have if it does go away, I'll have cash enough, but I'll also have that as a write-off, as an investment loss. So
yeah, right.
Just like, I was telling everybody I was going to go out and buy $100,000 Rivian. And to me, I'm like, God, it would be great to have a Rivian, but I could actually take that 100,000 and in 5 years double it.
Yeah.
So
the Rivian's going to lose value day one, right?
Yeah, exactly. So
that's a great point you brought up, though. We shouldn't overlook that. Like if if the investment does go south, like there is a write-off there. So there's a strategy to all of it. So there's even when there's a loss, there could be a win. It just depends on what else is going on financially and how much you should put in there, right? Whether it's $500 on a percent deal. Not that that's a recommendation to anybody, or 100,000 to 250 in one of these more larger funds.
Yeah,
but that's exciting stuff. Like I know it must be an avalanche of information you're digging through, right?
it's overwhelming.
Yeah, yeah.
But like
I
my
think what
buddy,
helps is like you have the real estate background, so I think the numbers make more sense to you as opposed to somebody who did it. Like how would this make sense or what? So that's got to help for sure, I would imagine.
yeah, the funny thing is I was rattling that off. I'm like, this is totally no brainer math for me, right? Because I do it every day. And then you slowed me down and had me reiterate it. So, if you want me to go over those numbers again, I can absolutely show you my mindset and put some more clarity to it. But to me, the ROI is there, right? Like you have a 1.9 multiple, meaning after X amount of years, it's going to double. Kind of like the same thing with the stock market, I guess, right? I mean, how often does your money double? The rule of 72. And God, I got to put that into my little equation too. Like the rule of 72 thing, it's like it would be like 3 years or 2 years or 4 years.
As long as the return stays steady. And that's where that principle falls out for the stock market, for example. Because like I remember in that sales technique I got taught, I was like, all right, man, so you're going to show a 12% return, right? So 12 goes into 72, 7 times, right? Whatever, right? Yeah, something like that. And so instead of taking 41 years to double, your money doubles every 7 years, right? It's like, oh, wow. Yeah, if you get 12% every year, right? Which is not going to happen.
I mean, not all of us are like Nancy Pelosi or Warren Buffett, so we just don't have the ability to know where that money's coming. And
there's another conversation. Like, so they, you can get apps now that like, oh, we follow the Nancy Pelosi tracker fund. What they don't understand is that they have very fancy call and put options like in their portfolios. So when they take those positions, that helps them avoid losing money, and they have income that comes in from selling and buying these things. You're not going to get that in any of those funds. You're not going to get her return. You're just not.
Yeah. Plus, even if you did make even money for that and all that other stuff was not true, when they report what they buy and sell, it's still 7 to 14 days after they do it. Right. So whatever damage that they did, they pulled out $300 million, and they just put in $700 million to whatever stock fund it was. That was 7 to 14 days ago.
Right. You end up buying high and selling low,
So you don't really they don't have to report it. At least I don't know if it's automated now, but
they do have to report it. They do have to report, and that's how these trackers get it.
Right, but how dated is that data?
Get it in real time. They can't execute in real time along with it. So
that's too bad.
Yeah.
I mean, we have AI. We have the most powerful computers ever known to man. How come we can't get their information real time?
Yeah.
Right. So, that's what this Forex guy does. He does his fund, and then I have to open up like this OX fund, like a Schwab fund that, and then they link their fund to my fund, and my fund copies every move that they do. But it's Forex. It's totally freaking out of my brain. And my I'm like this little tiny bear cub afraid of a growl at night when I hear this, because it's like, I don't understand it.
Yeah. And like I said, I've known people. I wonder if we want to come on here and talk about their experience with it. Over the last 10 years, since Forex trading became like a really big thing, who were just swearing by their success with it, the few months in. And then I want to say about a year and a half afterwards, like they swore it off for whatever reason. I didn't want to pry into like their experience because it didn't look like it was a good one. Right. So, they stopped bothering me about it big time.
So the way they were pitching it, first of all, it's $15,000 to get set up, and then it's $200 a month, and then whatever you fund it with, it could be 25 to whatever, like $1.5 million. But they have this thing called a no load or something where like your stop loss is like 12% of that thing. So if you're going to convert US to Vietnamese dong, I think it is, and they lose money, you'll only lose like 12% of that investment, which is like a microcosm of what they do, because they only take like little tiny bits of things, and they're trading all day long, which again, that's kind of crazy.
Yeah, I mean, some people do very well with it, though. You know, I'm not going to say it's not for nobody, because that's not true either.
Yeah, I mean, that's their. Oh wait, sorry. That's their claim right there, is 3,000 over the last 4 or 5 years. Yeah, sure.
Yeah.
I mean, if you're going to have to invest $15,000 plus 200 times 36, that's $60, $72, $100. You're putting in $22,000 over 3 years. You better have $100,000 or $200,000 into this for it to make sense for that kind of investment.
3,000% total return. Man, I wonder how they're measuring that by. But interesting stuff, man. I'd be curious to see how your journey through the private equity opportunity land turns out.
I'm set. I'm gonna do the private lending for sure, because that's guaranteed income.
Yeah,
and it's semi-safe, right? And
that's an industry you understand. So I think that's the key part right there.
Yeah, I mean, if it's something you understand, it doesn't make sense not to do it. So, and Scott does it, and I'm a copycat, and if he's going to do it, I'm going to do it, and why not? And and then the other stuff, I'm going to ink into over the next couple months and see where it goes. But again, when this house sells, I'm going to have a huge tax liability. So I got to figure out how to depreciate or get some kind of tax difference on that, something. So
yeah, good problems to have.
Yeah. So if you have any questions about what you want or which ones I've looked at, I'll give you guys screenshots. Just text me or comment down below, and I'll get to you somehow. I don't make money off of any kind of referral of this. This is just my own research that I'm doing for myself. And if you want to start a little chat, we can all get on and figure it out together.
Or if you have a lot of experience with this and you want to share, how you've done it and what's worked for you, what hasn't worked, what to look out for, I'd love to hear about that too. I'll research how I can make money off of it, off of referring, and I'll do that.
If there's something out there, Pat, that you can make money off of, let me know, because I'll put some money into the fund for you.
I was totally kidding, but awesome stuff, man. Yeah, this space is changing a lot, and so it's good to get more education out there about this so people can perk up and understand. Because I think as we go forward, like I said, it's going to change even more. Now they're opening it up to employer plans, so you have middle class people who don't have several millions of dollars and can now throw $250 at deals like. So we'll see how that changes these offerings going forward. So it'll be interesting to check back in here.
I wonder if your firm can create an ETF that would spread over 2 or 3 of these, and then you could take maybe 5% from 20 of your best clients and throw money into it that way.
That's what I'm trying to figure out as well, because I said these offerings are changing and they're developing these investment vehicles to be able to do that. I'm just curious how that affects the whole private equity market in general. Like how that's going to change. It's going to have an impact because you have an influx of new money, right?
Right.
So
I mean, if life insurance can buy into these types of stuff, I don't see why your company couldn't create an ETF for that.
Yeah, so more to follow. It's going to be interesting here.
All right. All right, stick on. Let me do my sign off. Thanks for watching, everybody. It's been a pleasure. It's been 1 hour and 9 minutes. That was awesome. Didn't even feel like that. It felt like, it's great. Always good talking to you. If you have questions or comments, or you want to share your experience, please do comment below, and we'll get a hold of you and we'll figure out how to get you on the show. Thanks for watching.
Let's do it.
Okay.
Ooh, got warm in here. Are you here still?